I grew from 0 to 200 million in 4 years. Profitable, non-VC backed. Because in 2001, 2002, I was begging and groveling VCs, please give me money, I'm dying. I invested every last penny I had. I borrowed $100,000 on my credit card. I was payroll 27 times. But in 2001, no VC wanted to invest in tech even.
OLX became a global classified giant with 350 million plus users across 30 plus countries. Walk us through the spaghetti on the wall strategy, launching in 100 plus countries simultaneously.
We didn't know where it was going to work. So we're like, you know what? The idea works well. It's easy to build. Why don't we launch in 100 countries? We spent $50K in 100 countries.
Having invested early in companies like Alibaba, Airbnb, and Flexport, all now massive companies, right, by the way. What did you see in them that others missed at those early stages?
Wow.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast, and today we have a very special guest, Fabrice Grinda, with us. Fabrice is a legendary entrepreneur and one of the world's most successful angel investors. Fabrice is the founder of OLX, the global classifieds giant with over 350 million users. He also built his first company, Zingy, to over $200 million in revenue after nearly going bankrupt. As an investor, he was named the #1 angel investor in the world by Forbes. He was an early backer of giants like Alibaba, Airbnb, and Flexport, and has over 350 exits from his portfolio. In this episode, we dive deep into his incredible journey. We'll hear about how he went from leaving McKinsey at 23 to becoming a serial entrepreneur. He'll walk us through the wild spaghetti on the wall strategy he used to launch OLX in over 100 countries at once. We'll also hear the amazing story of how he tried to buy Alibaba.com domain from Jack Ma before anyone knew him. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode.
Hey Fabrice, so good to have you on the VC 10X podcast. How are you doing?
I'm doing very well. Thank you for having me.
Yeah, it's a pleasure having you on. To start things off, can we first have your amazing journey of being a founder yourself to now being an investor? What drove you to leave McKinsey at 23 and then to become an entrepreneur and a very successful one at that? And how did those early consulting days help you in that journey of being a founder after that? Let's start with that.
So I'm probably a bit non-traditional because I went to McKinsey knowing I wanted to be a tech founder. It's just that, in fact, I went to college knowing I wanted to be a tech founder. But what happened is I went to Princeton, finished off my classmate. I'm like, I graduated, I was 21. And I'm like, I want to be a tech founder, but I'm shy, I'm introverted, I've never managed anyone, I really don't know business. Let's go to McKinsey. It's like business school, except they pay you. And so I went there for 2 years, learned everything I had to learn. And then I'm like, okay, I've learned what I need to learn. I can write a deck and to tell a story. I'm better at oral and written communication skills, at public speaking. Now let's go build a startup. And so it was obvious to me it was time to leave and it was time to go on and build startups, which is what I meant to be doing anyway.
Absolutely. That's quite interesting. So you, from the outset, you knew you want to be a startup founder, right?
Well, I knew that when I was 10, right? Like when I was 10, I got my first PC in 1984. When I was 10, it was a Compaq 8088. And I was like following the lives of Bill Gates and Steve Jobs. And clearly I wanted to follow in their footsteps. And I was in France and I went to the top school in France. And they were like, so what do you want to be when you grow up? And I was like, I want to be a tech founder like my role model. So they were like, what? You would betray the ideals of the French socialist revolution. So I burst out laughing. They weren't kidding. I'm like, okay, American dream, here I come. And so I left at 17 to go to Princeton and, never looked back.
Wow, that's an incredible story there, right? And OLX, right? A big highlight on your resume, right? OLX became a global classified giant with 350 million plus users across 30 plus countries. Walk us through the spaghetti on the wall strategy, launching in 100 plus countries simultaneously. What were the key lessons from markets that failed versus those that succeeded?
Yeah. So in 2005, I went to see Krem, first of all, in the US. And I'm like, hey, Craigslist is great. It's providing a public service to humanity, but it could be better. You should be moderating the content. You should have no spam, no scam, no prostitution. And by the way, the primary audience for this is women. They're the primary decision makers in all household purchases, right? They pick the house you live in, the babysitter you hire, the couch you buy, the car you. So you need to create a female friendly site, and you're the exact opposite of that. But he didn't care. He didn't want me to. And I said I'll do it for free. By the way, I said like let me run it for free and fix it. And so I'm like, you know what? If he's not willing to let me do it, let me see if I can build a better version of Craigslist. Now, the issue in marketplaces, of course, is what I love, is they have something called network effects. Ever more buyers bring ever more sellers, or more sellers bring ever more buyers. And so if someone already has network effects like Craigslist, breaking that is very, very hard. And so we didn't know where it's going to work. So we're like, you know what? The idea works well. It's easy to build. Why don't we launch in 100 countries? We spend 50K in 100 countries in like long tail SEM, so BMW, X3, Red, Delhi or Mumbai, 30,000 miles, so we were paying like a penny a click. And we go to like people that have listings to see if they can list, and then we see if we can match supply and demand. And it really worked in two countries, which were Pakistan and Portugal, and it worked very well, but a bit less well in India and Brazil. So we went from 100 countries to 4. And then we became very big in these 4, and then we started using the profits, especially in Brazil, and then we re-expanded from 100 to 4 back to 30. Now, to answer the question, why did these work when others didn't? I think it's a combination of like lack of incumbents. So there were no big established classified sites that were big. The ability to buy advertising that was cheap, so not that much competition in buying ads on Google and Facebook at the time, and frankly luck. And so why Portugal became so big, not very clear. I think maybe we had like in the cultural zeitgeist, so cool people started using it and it took off. But once we saw something working, we like doubled down and kept going.
Yeah, absolutely. That's quite interesting. And there's not a very general strategy that founders follow that, okay, we're going to launch in multiple markets simultaneously and then see which ones work and then go deeper in those markets. That's not the strategy that is usually followed. So that was your decision to do that. And did you have VC backing at that time when you were launching in all these countries and testing it out?
Yes. So I had I raised 10 million in VC. So what happened is my prior company, Zingy, I grew from 0 to 200 million in 4 years. So it was like 1, 5, 50, 200 profitable, non-VC backed. Because in 2001, 2002, I was begging and groveling VCs, please give me money. I'm dying. I invested every last penny I had. I borrowed 100,000 on my credit card. I was payroll 27 times. But in 2001, no VC wanted to invest in tech. Tech, the internet was dead. But eventually, when we became profitable, every VC said, I want to invest. And so I didn't let them invest because I didn't need the money anymore. I was like, where were you 3 years ago? And eventually I sold the company and it was a very nice exit. And so all the VCs that missed on investing were like, whatever you do next, I'm going to back you. And so we raised 10 million at a 28 million valuation on a PowerPoint at the launch of OLX. And that's why 100 countries, by the way, times 50K, that's 5 million. Right. And so I had the 5 million to do the tests to see where it would work. And the reason it's a different strategy that I use, but it worked here is classifieds is like, you do need to match supply and demand, but we're not actually doing payments and shipping and logistics, et cetera. So it's actually in a way easier to go global. We're like a Facebook. Facebook is pretty easy to go global because it's the same platform everywhere in every language, or Instagram or TikTok or whatever. And that's not true. If you want to build Uber, you need, or Ola or whatever, or if you want to build Zomato, you need, local delivery, local restaurants. I mean, then you need a very local team. You can't build that in 100 countries. So depends on the idea you had. But yes, I did have VC money. I created FOMO. And so I had $10 million in VC backing.
Absolutely. And Zingy is another very interesting story that we should cover, right? So after nearly going bankrupt with the first startup, you built Zingy to 200 million plus in revenue and sold it for $80 million in cash, right? What kept you going during the darkest phase of that journey? And how do you advise founders today who are teetering through on the edge of survival of their startups?
In a way, there's a saying in French, which is you cannot shave an egg. I had nothing to lose. 100% of my net worth was in the company. We were getting sued left and right by record labels. And I'm like, you know what? It costs you more money to shut me down than to let me operate. And by the way, I can make you money. And so I never, I don't know. I also like building something, right? Like, so I don't do any of these things to make money. I do these things because I like building. Like, this is my way of expressing my creativity. I think it's all a game. I think life is a game. And I think building a startup is a game. And it's a game I like to play. And so as long as it felt like the game was worth playing, it was worth continuing. Now, even though we were missing payroll, even though we were out of money, etc., I could see the potential here, right? It's a multi-billion-dollar category in other countries. There are a lot of reasons why I thought it would be big if we executed well. So there are moments where you need to stop playing the game, right? Like if the universe is telling you this is not working, there is no product market fit. You're not going to get there no matter what. Then of course you want to move on and go play another game.
Absolutely. So you're saying Zingy was bootstrapped all the way to $200 million plus in revenue,
Well,
right?
I did raise 1.4 million, but I raised it in like 10K increments. I would
Okay,
meet someone who's like, please fund my startup, but I get 10K here, 10K there, make
right,
payroll, then I wouldn't find money, miss payroll, find another
right.
20K, make payroll, etc. So I did raise 1.4 million, but it was like the most complicated raise of my life because it was all in like 5K increments.
Got it. And at what stage was this? Was super early stage of Zingy when you raised this, or later
Well,
stage?
little by little. First, I put every last penny I had in the company. So I had 700K plus 100,000 with my credit card. So first I put 800K in. Then I started raising, and until I ran out of money, basically.
Okay, and then after a point, you just stopped raising. Your business
Well,
just
at some
took a
point, I
lag.
became profitable.
Yep.
Being profitable is wonderful. You're the master of your own destiny, right? Like all these founders, right? Like announcing, I just raised 100 million and a 500 million valuation. I mean, that's the ego announcement. That doesn't do you any good. This is monopoly money. What you want is real money, that you could go buy coffee with. Yeah, monopoly money doesn't buy you coffee or a car or a house.
Yeah, absolutely. Zingy happened, and then OLX happened. I would say two successes, right? And then
Yeah.
after that, you went on to become an investor with started FJ Labs, uh, which is quite successful as of today, and you have become sort of the most sought after marketplace investor there is, right? So do tell us about that investor journey, how that started, what were the initial investments you made. I know there are some big names in your portfolio as well, but would love to hear it from you.
Yeah. My investor journey started way earlier than that. So when I built my first startup back in 1998, which is an eBay of France, it was called Octwins, I was a very visible consumer facing internet CEO. So a lot of other founders started reaching out and saying, hey, can you help? Can you invest? And so I thought long and hard, should I be an angel in parallel to being a CEO? Because it's a distraction from my core mandate as founder CEO. But ultimately, I articulated or argued to myself, okay, if I can articulate lessons learned to others, it makes me a better founder. If I can keep my fingers on the pulse of the market, it makes me a better founder. So as long as it's not too distracting, so if I can decide in an hour if I invest or not, then it's okay, let's do it. And so I started angel investing back in 1998. At the very beginning of my entrepreneurial journey. And so by 2013, when I'd left OLX, I'd already made like 170 investments. I'd had dozens of exits. So it was already doing very well. I'd already invested in Alibaba. I'd already invested in payroll. I'd already invested in Delivery Hero. So a lot of I'd already become a very successful angel. So continuing to do that, just like with more scale, came very naturally.
Absolutely. And as a matter of fact, you were named the number one angel investor globally by Forbes at one point, right? So, what do you think is the difference, a major difference between being a successful operator versus being a successful investor? What skills do you think were transferable from being a founder versus being an investor now?
Well, the first thing is I didn't join a VC firm. I built a VC firm, right? Like, so in a way, I'm building a startup. It's the same thing: defining a strategy, defining culture, hiring people, raising capital from LPs, which is not that dissimilar from raising money from VC. So a lot of the skills from if you're building a firm or transferable. Now, of course, the job is different. It's judgment, and the good news is I already had thousands of at-bats investing by the time I built a VC firm. So that was irreplicable. Not every operator is a good investor. Not every investor is a good operator. But in my case, I've been doing both since the beginning, and it came pretty naturally to me. Now, on average, I would say I prefer to be an operator than an investor. It's just, it's hard to justify the opportunity cost of time, given that I'm already very successful. The idea needs to have the potential to be huge to justify my time. And I find that there's a lot of leverage in working with a lot of founders. I can bring a lot of the things I've learned. They do the hard work, and I can try to reflect their trajectory and help them fundraise and strategically by being an advisor. And so in a way, I touch many more people in a much more diffuse way than I was as a direct founder, but it feels in a way more scalable. And it also is pretty compatible with my intellectual curiosity. I'm interested in solving the problems of the world. And there's not one problem. Like climate change is not one problem, it's thousands of problems. Inequality of opportunity is not one problem, it's thousands of problems, and thousands of founders are trying to track sub niches of that. And I like to be involved in solving all the world's problems.
Absolutely. And marketplace is somewhat your forte, your expertise, right? So, what's your specific framework for evaluating marketplace opportunities and how has it evolved?
There are four things I look at when investing in. We're looking at investing in startups specifically. One is the team. That every VC says I invest only in extraordinary people. Now, for me, extraordinary people is someone who's both a visionary, eloquent salesperson, but also knows how to execute. So the Venn diagram intersection of people that know how to execute and are visionary salespeople. Number two, do I like the business? Now, do I like the business as a combination of total addressable market size and unit economics? How quickly do you recoup on a contribution margin 2 basis your fully loaded customer acquisition costs? What is your LTV to CAC after 18 months, 36 months, et cetera? And they're pretty good. I have a pretty good sense of what type of metrics I'm looking for in terms of GMV growth at different stages, effective take rate, margin, et cetera. Varies obviously by industry, but obviously we have all the metrics that we're looking for. In fact, I've published them on my blog. Number three, is the valuation reasonable? I think it's cheap at that, but reasonable in light of the traction, the team, the opportunity. And then number four, do I like a thesis? Is it in line with my vision of where the future of the world is going in terms of like the future of mobility, the future of food, the future of real estate, et cetera, et cetera.
Yeah, absolutely. And with 355 plus exits from your portfolio and a 39% IRR, can you share some pattern recognition around what separates the companies that achieve meaningful exits from those that don't?
So companies fail for a bunch of reasons. The number one reason they fail is they don't find product market fit. So the idea, or they find product market fit that only lasts to a certain point and then it doesn't scale anymore. And so maybe you had a customer acquisition channel that worked until 10 million or 100 million, but it doesn't keep going. And therefore you can't scale at profitable unit economics. So that's reason number one, you don't find product market fit. Reason number two, if you have a co-founder, you're more likely to succeed, but if you fight with your co-founder, you will fail. And then number three, raising too much money at too high a price, right? Especially as a first-time founder, you're tempted to take the highest valuation, raise the most capital. But if you raise too much capital and you don't grow into the valuation because you don't want to do anti-dilution, you don't want to do down round, it's going to kill the company. And so the people that avoid this obviously find product market fit. They don't find for their co-founders, and they raise the right amount of money at the right terms that allows them to keep scaling in categories that are large enough with good unit economics that they get there. Now, there's an element of luck, right? Like you never know ahead of time if the idea you have ends up being a lot bigger than you think it is, right? Like Airbnb was inflatable mattresses in people's living rooms. It sounded like a small idea, but they tweaked it, became a much larger idea.
Absolutely. And I know MJ Labs publishes its own reports, regularly about what are the market conditions like and so on. So, can you tell us about how are you looking at the marketplace market right now as an investor? How do you look at the valuations going up or down? How easy it is to build one, or what are the challenges that you're seeing right now?
So it's never been easier to build a marketplace, right? Like now you have tools that are available with low code, no code, AI. It's easier to everything to build the stack. It's easier to like acquire customers. It's easier to integrate AI to translate listings, to have listings automatic. Take a photo and it creates the title, the description, the category. It suggests the price. I mean, so you can do a lot of interesting things these days with marketplaces, and there's a lot of marketplaces yet to be built. Now, obviously, if you're in the consumer side, a lot of things have been done. Like you have Flipkart, you have Zomato, you have Ola, whatever, you have Airbnb. But if you're in the B2B side, very little has been done, right? If you want to buy petrochemicals, there's no site where you can see a list of what's available. There's no connectivity to the factory to understand manufacturing delays and manufacturing capacity. If there's no online order, there's no online payment, there's no tracking of your order, there's no financing. And these happen in every industry and every vertical. Likewise, if you think of all the mom and shop SMBs and bodegas or whatever, everything's pen and paper. No one's actually automated so there's huge opportunities in marketplaces and B2B, both for large enterprise, for inputs, and for SMBs. Now, in terms of what are the trends, well, right now in venture, it's all AI all the time. So all the VCs or lemmings, they only want to invest in AI. I think 75% of the investments for the first half of the year went AI. 95% of the batch of YC is AI. It's all AI all the time. Which there's clearly an AI bubble going on now. AI will transform the world in a more meaningful way than we expect it to, but it's going to take a lot longer than people think, and a lot of dead companies along the way because too many people are doing the same thing and raising money too high a price. As a result, marketplaces are kind of unloved. Valuations are very reasonable. They're kind of back to where they were in 2019. But what's interesting is I think marketplaces are a smarter way to play out, right? Like, so you can invest in one of the LLMs, and then you can be fighting the game of kings, and you need hundreds of millions of capital, etc. And by the way, even the early winners like Lovable or Cursor may not be long-term winners as GPT starts releasing development tools and whatever. GitHub has Copilot and whatever. So I think there'll be a lot of dead bodies there. But imagine you're investing in a marketplace and then you use AI to make it significantly more efficient. You improve the listing process. You improve the customer query system. You improve the purchasing process. I think applied AI is probably the better way to play it, and you play it at more reasonable valuations. But as a founder, it's harder to raise in marketplaces, especially B2B, than it is in AI. And as a result, you need to raise enough money that you can get to the next round. And the valuations are more reasonable, which also means you're less likely to fail because you didn't grow into your valuation.
Absolutely, that's quite interesting. And do you think marketplaces are also going to evolve with AI coming in? Because now the purchasing behavior of people is also changing. Earlier, they used to directly go to the said marketplaces. You mentioned Flipkart or Amazon. They'd go there, search for what they want and get it. But now what's happening is they're first searching on LLMs that what would be the best brand to buy and what fulfills
That's actually
my...
not true, by the way, what you just said.
Okay.
There's three purchasing behaviors on marketplaces. One is if you know exactly what you're looking for, you just go to Google, or frankly, you go to Flipkart or Amazon and you just put it in, boom, you get it. There's no reason to use an LLM there. And a lot of people know exactly what they're looking for sometimes. That's one big search category. Number two, a lot of people go and do browsing as entertainment. If you go to OLX, you typically don't know what you're looking for. You're just browsing through listings. It's kind of shopping. Window shopping, and sometimes you find something and then you get it. But LLMs don't play a role here because there's nothing to make it more efficient. Now, LLMs play a role in considerate purchases. Oh, I'm moving to Delhi, but I don't know the neighborhoods. I can't, this is the budget I have. I need these many bedrooms. What do you recommend? Where are the trade-offs? Or I want to buy a new car, but I don't know. These are my uses. Which one would you recommend? Like that, LLMs play a role. But even then, it's not obvious that it ends up being on a ChatGPT versus on a Carvana. Carvana has every information about every car. Like Amazon launched something called Rufus. And if you want to ask Rufus, which sneaker to buy or whatever, it's really good at it. So it's not even then, it's not obvious. If I look in the marketplaces we are investors in, how much traffic is coming from LLMs, it's tiny, tiny, tiny. It's like 1%. Not even. Now, is it growing? Sure, but it's really more taking share from Google than it is taking share from the marketplace. So I don't think they disrupt marketplaces, because the marketplaces are winner takes most. they're doing the fulfillment, the customer care, they have the liquidity, etc. So the share of wallet I think that the LLMs can capture is no more than the share of wallet Google captures.
Got it. Got it. Yeah. Thanks for sharing that. And you mentioned that you have identified B2B marketplaces are still in their early stages, right? So, what makes B2B marketplaces particularly compelling now, and how do they differ from B2C marketplaces?
The reason they're compelling now is there's a generational shift where the people that were running them or in like or that are running whatever the RFPs at like a chemical company, they were like their 60s and 70s and they're retiring and they're being replaced by millennials. And the same thing is happening in SMBs. Like the owners of these SMBs are retiring. Their kids are not taking over. It's where they're selling them to private equity. And so these people coming in, prefer to use online tools and RFPs, and they would and they're trying to make them more efficient. So when private equity is buying um laundromats, obviously they're going to bring in as many tools as they can to make it as efficient as possible, or bring software and inventory management and fleet delivery management, etc., which or tools that like someone who's 70 or 60 was not using. And so there's a very good why now. Now the difference between the consumer facing ones is a lot of people that are running these typically come from the industry. Because if you need to create a behavior change, you need Dow Chemical to like change the way they buy or sell their petrochemicals. It helps if you've been in the industry and you can go talk to the CEO or CO and say, "Hey, I've created this. You should definitely use it. It'll save you a lot of money." Versus if you're a 23-year-old Stanford grad, right? So the profile is more a 40-year-old, 45-year-old who comes from the industry.
Got it. Yeah. Thanks for sharing that. That's definitely adds more perspective. And how is AI fundamentally changing marketplace defensibility and network effects? Are traditional modes becoming less valuable now, or is it still the same?
No, it's still the same. It's still winner takes most. And if you have liquidity, you don't lose liquidity. If anything, AI makes you even stronger because so let me give you an example. We're investors in a fashion marketplace in Europe called Vinted. They're absolutely crushing it. They're like, I don't know, 10 billion in GMV, a billion net revenues, super profitable. And they added so they're already the winners, they're already leaders in each of the countries they're in. Then they added AI to translate the listings between whatever Polish and German and French. Then so then you have more listings in every country. Then they translated the conversations between the buyers and sellers. So you may be in France, but you're actually talking to a seller in Lithuania. You don't even realize it. They integrated payment shipping. Then they lowered the customer care costs by automating customer care. Then they automated the listing process. So you can take a photo and it tells you this is the item, title, description, category, price. So it makes it simple. So the visit to listing rate goes up, the visit to purchase rate goes up, and the costs of transactions goes down. So it makes them way more efficient. And so it makes the winners win even more, as long as they adapt it, right? Like, so, I mean,
Right.
if you're an old school incumbent, like OLX, I suspect has not been a first mover AI adopter, but like the fast moving transactional marketplaces have been very good.
Absolutely. Yeah, that's quite interesting how marketplaces are using AI to make it more efficient and improve their processes internally, right? Uh, Having invested in early in companies like Alibaba, Airbnb, and Flexport, all now massive companies, right? By the way, what did you see in them that others missed in at those early stages?
Well, it's different in each of them. I went to study at Beijing Normal University in '94. I learned Mandarin, and when I launched my first company, Auckland, the code name was Alibaba. So I tried to buy the Alibaba.com domain name from Jack Ma, who said no, obviously. I didn't know who he was, and I was always following Jack and Taobao from afar. And so when the opportunity came in, I think 2009 or 2010, 2011 to buy some shares, it was pretty obvious that they had something magical. They just turned on monetization. It made sense to invest. Flexport Brian is a superstar. And the idea of like fixing international logistics, which is a $1 trillion category, made a lot of sense and making it more efficient. So B2B marketplace by excellence. Um, and what was the other company you mentioned?
Yeah,
Airbnb?
Airbnb.
Yeah, and
Yeah,
Airbnb very quickly, I realized they had global network effects because people were traveling internationally, and so when they were winning one country, they started winning the others, and and I loved it. Like I was a user of Airbnb very early on, and a power user. I was renting my own places. I was renting places on there. I lived in Airbnbs for 3 years. I in 2012. when I gave up all my possessions to charity, I lived in Airbnbs from 2012 to 2015. So I was a power user. So it was obvious for me I needed to invest.
Absolutely. All amazing stories there, right? Uh, you've been investing in cross-border marketplaces and live commerce as key 2025 trends. Why do you think these specific areas will see breakthrough moments now?
Well, there's a big geopolitical or grift or shift happening, right? Where people will have to move because of Cold War II between Russia, China, Iran, North Korea on one side and the West on the other. People have to move their supply chains out of China. And so clearly there's a trend towards what I call friendshoring, moving the supply chain out of China, mostly into India. And so I've invested in companies in India that are trying to export to and that are helping fulfill and provide inventory to international companies, especially in Europe and the US. So Ziad is an example of that for apparel. They're doing the RFQs because obviously the mom and pop guy who's trying to just manufacture apparel, he doesn't really know how to talk to Zara and H&M and answer RFQs and yield customs and shipping and pricing. And so Ziad will do all of that for them and get them big orders, and then they just need to execute a manufacturer. So this is an example of like cross-border marketplaces that India is the place by excellence today.
Absolutely. And what about live commerce?
So live commerce is whatnot in so it's much bigger in China than it is in the rest of the world, mostly because it's been pushed by the main platform. So Taobao Live is like 25% of the commerce on Taobao. And in the US, Amazon, eBay never launched live in a meaningful way. And so it ended up being taken over by like whatnot in certain categories. But now we're seeing more use cases of it. So we invested in a company called Palm Street, and they're selling rare plants by live commerce because it makes a lot of sense that you buy rare plants. There's a story around them, you how to take care of them, where they come from, etc. through that medium. And so we're seeing these small businesses that are like doing 2 live streams per week, and they end up selling like 10,000 per month on the live stream. So doing really, really well. And so it's happening in more and more verticals little by little.
Absolutely. Yeah. What I'm observing is that different countries or regions in the world have different marketplace or commerce trends. You know, how their shopping is different based on the region they come from, right? And you kind of have this global scope in your investing activity that you're able to see these trends in one region, and you can see that, okay, maybe this is going to replicate in other regions as well, and you go and invest early in those companies. Is that a correct assessment of how you're doing it?
Yeah, it is one of the ways we're doing it. We're seeing a trend in a country and we're like, oh, this is interesting. It probably, if it works somewhere, it's probably going to work somewhere else. Let's go see if there's an equivalent in another country. It's not, I mean, I say most of what we invest in is more business model innovation. Like, so adding new layers of new different approaches to marketplace design or business models or AI. But we do some international arbitrage where like, oh, live commerce works here, let's go do it elsewhere as well, though it's not a big chunk of what we do.
Got it. Yeah, I just thought that was a theme because, you know, even OLX, there was Craigslist that was adjacent to it, and then you saw that, okay, there are other markets that are not tapped into by any other
Yeah.
players, and there was an opportunity there, and you
Yeah,
tapped
that
into
was
that.
definitely the theme then. But like right now, most of our
Yeah,
investments are in the US, right? And in the US,
got it.
you need to innovate. You're not, there's nowhere to copy. So most of the things we invest in these days are like new innovations, new business models, new approaches.
Got it. Interesting. And something that's interesting about marketplaces is that they sort of have an inflection point, right? Where in the early days, it's extremely hard to build a marketplace because there are two sides of the equation, at least two, can be more as well. And then you have to bring both of those on the platform and engage meaningfully so that both those parties get value out of the platform, right? And initially, it's extremely hard. The chicken and egg problem, as you know it, right? But after a point, it reaches an inflection point and it takes a life of its own. And then let's call that PMF or something, but it blows up from
Yep.
there. You know, so how do founders who are in the early stages of solving that chicken and egg problem, you know, starting out that platform and bringing new people in, what's the ideal GTM approach for them that you've
Yep.
seen startups in your portfolio take that you can advise to them?
So usually you start focusing on the supply because the supply is financially motivated to be on the platform. If you go to a seller, you're like, hey, I may have buyers for you. Do you want to be here? It's free. We'll take a commission if it works. Most people say yes. But the key is curate the supply. Only bring very little that's high quality, that's engaged. Because imagine I wanted to build a locksmith marketplace in Delhi. I could probably, hire a team, call every one of them, have 100% of them on the platform, but then I have no demand for them. So they're not they're going to churn, they're not going to reply, etc. Instead, you take one and one zip code. You bring enough demand that he's very happy, and you represent 25% of his revenues, and then you bring another one. And so you start supply, bring demand, add a bit more supply, bring demand, always matching the two. The biggest mistake you can make as a marketplace founder is you get so much supply that your demand, you have enough demands that the sell-through rate is very low. So if you're selling used goods, you have liquidity if at least the probability of the item selling that you're listing is 20%, 25% at the low end. Less than that, you probably don't have liquidity. If you're a service marketplace, you want to represent at least 20% of the earnings of the labor on the marketplace. And so then you have product market fit. It's even more. Then you have network effects. Then you have ever more sellers where you have more buyers, and more buyers where you have more sellers. Until then, you need to make it happen, basically.
Absolutely. So there we have the solution to the chicken and egg problem, at least in marketplaces. The high quality supply comes first, and then you build from there and bring the buyers in.
It's not
Right. And
true. It's true in
okay.
99% of the cases. There are a few cases where you do demand first, but in most cases, you get the supply just because it's easier to get, right? They're financially motivated to be there.
Absolutely, I completely agree. And there's one term, take rate, right, in marketplaces, which is the share you'll take from the total revenue generated for the suppliers on your platform, right? Uh, how do you see that in the early days? Do you see marketplaces when they are in the early stages, take less rate from their suppliers, and then as the platform strengthens, there are more buyers, there's more brand equity, then they start to increase that take rate? And what are the general, rates you're seeing in the early stages when it's not established yet, and then from to the mature stage, let's say. Not to the Airbnb stage, but even before that, what's the standard rate you're seeing as take rate in marketplaces?
Um, the answer for us is it depends, right? So the way you measure what take rate you can take is you measure the elasticity of supply and demand, and you take the take rate on the more inelastic side. Now, on most marketplaces, you take a 3 to 25%, so big range, take rate on the supply side. But there are a few cases where you take in the buy side because that's where they get value. I'd like to charge the people that are getting the value. So Vintage charges the buyers because they're getting value from the escrow and the shipment. But if you pick at home, they're charging the sellers because they benefit from the home pickup. Now, to answer your question, I would start with a low-ish take rate, but but non-zero, because you want to make sure people are willing to pay. And start, but so most marketplaces in the consumer side, I'd start at 10 with the objective of going to 15, 20 in the long term. On the B2B side, way different. Some cases you cannot take any take rate because it's too, the orders are too big, it's too price sensitive. Then you use different models of business model. So I will, because you have a marketplace, it doesn't need to be that the business model is a take rate. The business model could be self-serving ads, right? So we're investors in a company called TopSort, and they allow the sellers to buy ads to improve placement. In which case, in some cases, 5% of GMV is through these ads that are self-service. You can sell our financing, you can sell listing fees. There are a whole bunch of ways that you can monetize a marketplace, of which take rate is only one of them. That said, if you can try to have a take rate, typical B2B take rates are 1 to 3%, maybe going to 5, 6, 7, and typical consumer take rates are 10, going to 15, 20.
Got it. Yeah. Thanks for sharing that. That's going to be helpful for our listeners. One thing that I've seen is that once these marketplaces are established, let's take Airbnb, for instance, or let's take Zomato in the Indian market, in the food and restaurant space, this sort of become a monopoly in that
Yep,
they get to that stage, right? There are only one or two winners at most in marketplaces, which is something that investors love.
yep.
Absolutely. But from the consumer point of view, marketplaces can also start to become exploitative at that stage, because since you control the entire brand equity of a particular category, you can command any take rate that you want, and suppliers would
Nah,
still
that's not
have
quite
to.
true. So first of all,
No.
because there are
Okay.
natural monopolies, because the ever more buyers were raising more sellers were raising more buyers. That's why I think they're protected from LLMs, because at the end of the day, even the LLM will just send you to the dominant monopoly provider. You cannot command any take rate you want, because there's a point at which it's non-economic to be on the platform and you're disruptible. People that took too high a take rate and were ultimately disrupted, right? Like the reason Taobao won in China, eBay had bought the leading player called EachNet. They had 95% market share, but they started taking too high a take rate. Taobao took the market away from them. The same thing happened to eBay in Korea. They had a company called K something or other, and it was disrupted by G Market for singling. They didn't take they took a lower take rate. So there is a natural fair take rate that people will bear, but you can't just take 100%, right? Like by definition, like everyone will churn. So I do bet that's true. You have more pricing power when you're the winning natural monopoly. So will the winning natural monopoly have a higher take rate than at the beginning when it's competitive? Absolutely. But will it be completely exploitative? No, it'll be high enough, as high as possible for them to make money, but not so high that it creates an opportunity for someone else to come in.
Absolutely, quite interesting. And what you're also seeing, let's take the example of Zomato in India. It's a publicly traded company now, and it's trading at a massive, massive valuation, right?
Mhm.
And there is debate around it that, okay, is that valuation reasonable or not? As someone who's a veteran in the marketplace space and knows the Indian market, especially in and out, do you think Zomato or that size and the brand equity that they've established, it's justified for them to command that higher valuation? If yes, then does that have any takeaways for the companies that are playing in the private market and the valuations there? Does that have any influence on that?
So let me start by saying that I'm not a public market investor. I don't look at public market comps. I don't look at value, because I usually sell when a company goes public, because I lose my proprietary access to the founder, right? Like if one's private, I can call up a CEO. It's like, hey, how's it going? Can I help, etc. The minute they're public, I'm tiny, first of all. Fidelity is a big investor, and they're not allowed to give me any information. So what is my comparative advantage as a public market investor? It's zero. So I sell when they go public. Um, Now, why could I make an argument that a company like Zomato should command a high price? Um, and again, I have no idea what the multiples are. I have no idea what the valuation is. I don't know. I don't even know what the percentage penetration of online food ordering is in India. But I can make multiple stories that to justify hyper valuation. One is online food ordering in India is whatever 10%. It's going to go to 50%, right? It's going to go up dramatically, and this is a huge market. Two, I can imagine a future where the marginal cost of delivery of food, with a combination of drones and self-driving vehicles and delivery mechanisms, goes to zero. And then your margin just increases dramatically. Now, is that happening in the next 3 years? No. At some point in the next 10, probably. And number three, can I imagine a future where in high real estate markets, cost markets of Mumbai or Delhi or whatever, if you have enough dark kitchens that cook food that's prepared in 3 minutes, can be delivered at zero cost by drone, uh, you can have an extraordinary meal delivered to you in 10 minutes that's cheaper than if you want to go to buy the groceries and to replace the grocery market. And maybe you even create homes that don't have kitchens in the future. Yeah, I can imagine that. I mean, again, is that 5 years from now? No. 10 years from now? Probably not. Maybe more 15, 20. But I can paint a story of how this can be very, very, very big and much more profitable than it is today. And now it's probabilistic, and would you pay to that future potential valuation today? Maybe, maybe not. But there are reasons for why I'm personally very bullish on food delivery writ large, in India and a global market.
Absolutely. And the last part of the question was that, uh, do private marketplaces who are still private but have still matured and are in that journey to IPO, but still raising private rounds, do they have any takeaway from the valuations that are being commanded in the public markets? by companies like Zomato?
Well, the problem in the rest of the world is the opposite. Is the public market valuations are lower than the private market valuations. And so the companies are having trouble going public because they raise too much money at too high a price, and they don't want to suffer the ignominy of like having to go public at a much lower price than they last raised. So the later stage your startup is, the more relevant the public market signals are. Now, if you're a marketplace that is not in food, how relevant is the Zomato multiple? I'm not sure it's that relevant, honestly, because different growth profile, different margin profile, different, Zomato's a three-sided marketplace. It's restaurants, consumers, delivery people. Most marketplaces are two-sided, right? Like, so I'm not sure it would be that relevant, but yes, are public market valuations relevant for late-stage private companies? Absolutely. The bigger problem, as I said in the US, is the opposite. It's the private ones are too expensive relative to the public ones, and so it's creating it's making it hard for them to go public.
Got it. Yeah, makes sense. For founders building marketplaces today, what are the biggest hurdles they need to overcome in today's market that didn't exist when you were building OLX or at that time?
I'd say, first of all, it's a lot easier to build one than before because, with no code, low code AI, you could build anything and like no money. So there's going to be a lot more competition because if you have a good idea, everyone will copy it. Um, Customer acquisition is not obvious, right? Like the costs of customer acquisition have gone up pretty dramatically. And so figuring out how you have a scalable, repeatable, sustainable customer acquisition channel. And it doesn't matter to me what it is. It could be paid, it could be organic, it could be influencers, but it needs to work and be replicable. I think is reasonably hard. And then many of the consumer categories have been taken. So you need to take very new, innovative approaches, or you need to go B2B.
Got it. Makes sense. Moving to my last main question before we try to wrap this up. What's one contrarian belief that you have about the future of marketplaces or venture investing that most people would disagree with?
So I think most people right now are like, it's all about AI all the time. And I think there's a bubble in AI where, yes, AI will change the world, but like every other tech revolution, it's going to take a lot longer to impact the world than people think, because before the government of India uses AI intelligently, or whatever, a big, massive company, I think it's going to be a long, long, long time, or definitely the government of the US and France, etc. And that's most of GDP. But in the future, when it is applied, it'll transform society more than people can imagine. So it's overestimated in the short term. It's underestimated in the long term. But that's like 10, 15, 20 years from now. And so people have written off marketplaces. So right now, the contrarian thing to do is invest in marketplaces, right? Like the non-contrarian thing is invest in AI. The contrarian thing is invest in marketplaces as a bet on AI, because I'd rather do applied AI than actually do direct LLMs that are super competitive at crazy prices. And so to me, that's the contrarian bet. A lot of people are like, oh, marketplaces have all been done. And I disagree. If you look at B2B supply chains and SMBs, we're like sub 5%, often sub 1% penetration. We're day zero. Everything needs to be built. And this is trillions and trillions and trillions of dollars of the economy that need to be digitized.
Absolutely. Yeah. Thanks for sharing that. With that, we move to the rapid fire round, wherein I'll ask you 6 quick questions about the investing you're doing, and you have to give 6 quick answers. All right.
Go for it.
Awesome. So the first one is, what are the sectors and regions you invest in?
US, Europe, India, Latin America. And sectors, any industry, but marketplaces and network effect business.
Okay. What's the typical stage of investment?
Every stage is difficult, but the earlier ones are more difficult because you have no idea if you're doing a good job or not for 10 years. You invest at seed and it takes 15 years for the company to go public. So you don't actually really know if you're any good.
Okay. But at what stage you like to come in as an investor?
Oh, I like to invest at seed and A.
Seed and A? Okay.
Seed and A. I do some Bs, I do some pre-seed, but or bread and butter, it's seed and A.
Got it. Got it. Do you lead rounds?
We don't lead rounds. We are the friendly value-added investor that writes swap shots of like 300-400K.
Okay. Got it. The next one also you covered, which is typical check size. Next one is, where can founders get in touch in case there's a direct way?
The best way to reach me is to go to my LinkedIn and send me an email. I will review it. Or an even better way is you send me an email if you have my email, or if you know someone who knows me, and you get a warm intro. But if you can't get a warm intro, go to my LinkedIn and mail. It'll work.
Awesome. Where can our listeners follow you?
The best way to follow me, frankly, is my blog, fabricegrinda.com.
Awesome. I'll make sure to put that link in the show notes below. Thanks so much for making time for this, Fabrice. It's been a pleasure having you on the podcast and loved all your insights on your journey and marketplaces, especially. So thanks so much. And I wish you happy investing.
Thank you for having me.
Thanks so much.